Welcome to the Deep Dive. We're here to sift through the info you send us, pull out those key insights, the things that really sharpen your understanding.
Yeah, make you well-informed fast.
Exactly. And today we're diving into a really interesting one. Just one thing. 12 of the world's best investors reveal the one strategy you can't overlook. Edited by John Malden.
Now, this is from 2006, so it's a bit of a snapshot in time, but the core ideas still incredibly relevant, I think.
Absolutely. Our goal today is really to distill that actionable wisdom, get into the strategies, but also the psychology behind investing that these, giants of the field shared.
Right. We want to give you a shortcut to what mattered then and, frankly, what still echoes in markets today. We'll hit on different strategies and definitely those human quirks that influence our financial decisions.
Okay, let's jump right in. First up, Andy Kessler's piece, Signposts in the Fog. What really grabbed me was his idea that investing in the obvious, what everyone already knows, that's basically a ticket to average returns.
Or worse sometimes. Yeah, Kessler's whole thing is that the big wins, the real edge, comes from being out there in the fog where things are uncertain.
So it's about spotting those emerging trends, right? He calls them yellow rocks or signposts.
Exactly. Identifying them and getting in before they become common knowledge. It takes a certain comfort with ambiguity, doesn't it? Being able to see potential when it's still fuzzy.
And he gave some great examples of trends he saw back then, like elasticity.
Ah, yes, elasticity. The idea that dramatically lowering costs can just blow open huge new markets.
He mentioned Charles Schwab, how slashing fees revolutionized investing for regular people.
Right, opened it right up. Or think about cars today, just packed with more and more electronics. That cost comes down, the demand just explodes. It's that same principle.
It's still so relevant, isn't it? Cloud computing, for instance, lower data costs, and boom, whole new industries.
Totally. It's a powerful lens for looking at innovation, that cost catalyst idea.
His other big trend was intelligence moving to the edge of the network, decentralization.
Yeah, PCs, smartphones later on, all that computing power spreading out. He contrasted that with the big regulated monopolies, the old telcos and cable companies.
Where innovation was maybe a bit slower, more constrained.
Precisely. The edges were where the action was, the rapid changes. Centralized versus decentralized, that dynamic still plays out constantly.
It really gets back to that aha moment. Spotting things early in the fog before they're blindingly obvious takes some skill or maybe luck.
Maybe a bit of both. Okay, let's switch gears. Dennis Gartman, not so simple rules of trading. This is much more hands-on, market-focused.
Very pragmatic. Based on observing how markets actually work, not just theory.
Absolutely. And his rules, they sound simple, but there's depth there. Rule 1, bull market. Be long or neutral, bear market, bearish or neutral.
He credits Keynes, but also mentions learning it the hard way with Gary Schilling.
Right. And that quote, markets can remain illogical longer than you can remain solvent. Every trader feels that one eventually.
Oh, yeah. It's a lesson in humility, isn't it? The market doesn't care about your brilliant analysis if it's moving the other way.
Exactly. You have to adapt. Sometimes just stepping aside, being neutral is the smartest move.
And his other main rule, cut losses quickly, let profits run.
And even add to winners, that office mantra. What's working? Do more of it. What's not? Do less.
Sounds easy, but emotionally it's tough. Cutting a loser feels like admitting defeat.
It is tough, but crucial for preserving capital. And just as hard is having the discipline to stick with a winner and not snatch profits too early.
Okay, moving on. Mark Finn's chapter, The Triumph of Hope Over Long-Run Experience.
Yeah.
This one really challenges a core assumption, doesn't it?
It really does. The whole idea that a manager's past performance is a reliable guide to the future. Finn throws some serious cold water on that.
He uses that signal-to-noise ratio analogy. It's hard to tell if good returns are skill the signal or just market randomness the noise.
And there's a lot of noise in market returns, right? So much volatility makes it tough to isolate genuine skill, especially over short periods.
He mentions metrics like the Sharpe ratio or information ratio.
Sure, people use those to measure risk-adjusted returns. But Finn's point is, you need a long time, years and years of data, to be statistically confident that it's skill and not just luck.
A couple of good years could just be riding a wave.
Exactly. Relying heavily on short-term track records is pretty shaky ground, statistically speaking.
He used that value versus growth stock example, too, how leadership can shift dramatically.
Yeah, figure 3.1 shows how betting on yesterday's winners, like maybe late 90s growth stocks, could lead to a lot of pain later. Markets are cyclical.
What was hot goes cold. Chasing performance is dangerous.
Definitely. Finn also digs into the psychology behind why we cling to past performance. Hindsight bias is a big one.
That I knew it all along feeling makes the past seem way more predictable than it was.
Right. And we tend to assume cause and effect, attributing success purely to the manager, even if luck played a huge role. Plus, we look for shortcuts, you know. Good track record must mean good manager.
So what does Finn suggest instead?
He says focus more on the process. Understand how the manager invests. Look for strategies that are uncorrelated to diversify risk.
You mentioned a Bayesian approach, kind of updating your view as new evidence comes in.
Yeah, basically start skeptical and adjust your beliefs based on data, but don't just blindly trust the past. And that idea of volatility throttling, giving more weight to managers with smoother returns, that's interesting too.
So it's about looking deeper than just the recent numbers. More analytical, more risk-aware.
Precisely. Okay, let's talk A. Gary Shilling and the long bond. Now, that was a contrarian call back in '81.
Predicting the bond rally of a lifetime, saying long-term interest rates would fall for decades because inflation was going down.
Yeah, and his reasoning was pretty interesting. He linked inflation partly to big government spending, Cold War, war on poverty.
But then he saw this shift, a growing public distrust of government after Vietnam, Watergate.
And he believed that distrust would ultimately lead to less inflationary pressure, bringing rates down over the long haul, which was not what most economists thought back then.
He included that chart, figure 4.7, showing how forecasts consistently miss the trend downwards.
It's a great illustration of how consensus can be wrong. Schilling's independent thinking, based on his read of these big social and economic forces, really paid off. It shows the value of non-consensus views, if they're well-reasoned.
And he put his money where his mouth was, leveraging 30-year treasuries. Took some losses initially too, right?
He did. It wasn't a straight lineup. Shows the conviction needed. And it busts that myth that bonds are just boring widow and orphan investments.
He points out they can be volatile, you can use leverage, but they're also fundamentally safe treasuries, anyway liquid, and have call protection.
Compared to stocks, he argued, bonds are actually simpler in some ways. Fewer variables than trying to value a company.
He also listed all those deflationary forces he saw coming. End of the Cold War, central banks getting serious about inflation, globalization, tech productivity.
A lot of those forces are still debated today, aren't they? His framework was pretty comprehensive, and he made that distinction between expected return and probable return higher yield often means higher risk of things going wrong.
Okay, Mark Finn again with Risk is Not a Knob, another great title.
Yeah, and a crucial concept. Risk isn't something you just turn up hoping for more return. Higher potential return should be the compensation you get for taking more risk.
Right, it's not automatic.
Yeah.
And he brings in inflation again, how even breaking even nominally means you're losing purchasing power over time.
Those figures, 5.1 and 5.2, really drive that home. Inflation is this constant headwind for long-term investors.
And volatility, too. He shows how more volatile returns, even with the same average, lead to lower compound growth.
Figure
5.4, right?
Exactly. Smoother returns compound better over the long run. Volatility has a real cost that people often underestimate.
He also critiques how modern portfolio theory gets used sometimes. Diversification helps with company-specific risk, sure.
But not market risk, the beta. You can't diversify that away entirely. Your expected return is still tied to that overall market exposure.
Plus, he noted the explosion of investment choices since the 80s makes true diversification harder, ironically.
And back in 2006, with high PE ratios and low bond yields, he was questioning if the potential return justified the risk in traditional assets. A good reminder to always consider the current market context.
Now, for something completely different, but maybe the most important, James Montier, psychology matters.
Yes, behavioral finance, how our own minds trip us up. Monty talks about the two thinking systems, the X system and the C system.
X is emotional, fast, intuitive. C is logical, slow, deliberate.
That's the gist of it, yeah.
Okay.
Table 6.1 lays it out. And evolutionarily, that fast emotional X system often gets first dibs. He even points to the brain regions involved, table 6.2.
Gets into fear pathways, the low road versus high road response. And William James's idea that maybe emotions start with physical responses.
It's fascinating stuff. That Iowa gambling task example was striking people with emotional deficits actually made worse decisions because they lacked that gut feeling of risk.
Shows how emotions are crucial, even if we think we're being purely rational.
Definitely. And Montier notes how affect intensity, how strongly we feel things impact self-control, especially under pressure.
Then comes the list. The biases. So many biases, like the bias blind spot.
Yeah. Thinking we're immune, but everyone else is biased. That's a classic.
And overconfidence,
Mm.
especially among professionals, funnily enough. Figures 6.9 to 6.11 show that.
Yeah, the data is pretty humbling. Professionals often know better than chance, but much more confident. Then there's confusing big with important drowning in data, but missing the point.
Hindsight bias again. Anchoring getting stuck on irrelevant numbers like that Wheel of Fortune, or even your Social Security number influencing valuations. Figure 6.13.
It's amazing how powerful anchoring is. And memory being reconstructive, the recency effect making us overweight recent events or vivid stories over stats.
Framing how saying 90% survive versus 10% die changes choices. Status quo bias, endowment effect, valuing what we own more.
The mug experiment, figure 6.18, illustrates that well. And of course, loss version hating losses way more than we like gains.
Monte sums it up with Hirschleifer's 4 causes: self-deception, mental shortcuts, emotion, and social influence. Figure 6.8, it's a minefield out there.
It really is. Understanding these biases is the first step, though maybe not enough to overcome them entirely.
Okay, switching tone a bit. Bill Bonner, the means are the ends. More philosophical.
Yeah, quite skeptical about economics and government intervention. He stresses watching actual human behavior, power, glory, money are the drivers.
He warns against arrogance, basically, thinking your grand plan should override everyone else's choices.
Especially when politicians or economists try to use political force to get their way. He argues for sticking to civilized voluntary means. The ends don't justify coercive means, essentially.
Makes sense. Now, Rob Arnott and the 2% solution. Back to indexing.
Right. He critiques standard cap-weighted indexes like the S&P 500, says they inherently overweight the overvalued stocks and underweight the undervalued ones.
Because the bigger they get by price appreciation, the bigger their weight. Creates a return drag.
That's his argument. He says even simple valuation in different indexes, like equal-weighted ones, tend to do better, maybe by 2–4% a year historically, though they have other flaws.
But his main thing is fundamental indexing.
Exactly. Weighting stocks by fundamentals, sales, dividends, book value, cash flow, whatever, not market cap. He shows data, figures 8.1, table 8.3, suggesting this offers a structural edge.
Better performance, even risk-adjusted.
Significantly better, according to his research.
Yeah.
He kind of dismisses technical analysis as parasitic, relying on the fundamental work others do. Focus on real economic facts, he says.
Interesting take. Okay, Michael Masterson, the winner's rule. This feels more like life advice that applies to investing.
It really is. His core idea. Make your efforts genuinely good for other people. When they benefit from you, success tends to follow you.
Give before you get.
Pretty much. Examples like fixing up a business before you try to buy it, or being an employee who delivers way more value than they cost, being a good mentor focused on the other person's success.
That John Huntsman quote is great. Figure out what you'd want from a broker, give your customers that, and then a little more.
Yeah, it's about building positive relationships and reputation. Larry King's foreword summed it up. Nice guys finish best. Maybe not always in the short term, but over the long haul.
Richard Russell. Rich man, poor man. Some hard truths here.
Especially rule #3. Wealthy people often don't need the markets day to day. They have assets throwing off income.
While the little guy feels pressure to make money, speculates, becomes a money nerd, always chasing something.
Right. Often on a financial down escalator, as he puts it, he hammers home the power of compounding over time as the real asset. His muni bond example illustrates that.
He also says hope is a money loser. Don't ride losers down. Take small losses.
Crucial discipline. And his point about action, thinking is rehearsing. You have to actually do something. Analysis paralysis is real.
And that kicker about stockbrokers rarely getting rich because they never believe their own bull. Ouch.
A bit cynical, maybe, but provocative. It questions the alignment of interests sometimes.
Okay, last chapter. John Malden himself, the Millennium Wave. Looking big picture.
Yeah, acknowledging change is constant, prediction is hard. He brings up Grantham's study on PE ratios and future returns, figure 12.1.
That investing in the cheapest stocks historically gave much better 10-year returns than investing in the most expensive ones, which often yielded 0.
Exactly. A stark warning against chasing high-flying, expensive markets. Leads to buying high, selling low.
He talks about secular bull versus bear markets, needing different strategies. Protect capital in secular bears.
And again, emphasizes psychology driving cycles and bubbles. It is almost never different this time. Famous last words, right?
But he also looks forward, sees potential innovation booms in biotech, quantum, energy, maybe several overlapping.
And demographics, aging West, growing Asia, huge implications for migration, economic power shifts, plus unsustainable government promises in developed nations.
Big challenges there. Taxes up or benefits cut. Probably both.
Likely. He sees economic power shifting east, China, India, and quotes the sovereign individual on market forces potentially overriding governments. It's a wide-ranging, future-focused perspective.
So wrapping this up, we've covered a lot of ground from just one thing. Spotting trends, managing risk, the limits of past performance, market cycles, psychology.
Fundamental value, ethical approaches, long-term forces like demographics and tech. It's a rich mix of perspectives.
The main thing for you, our learner, is probably to let these different ideas marinate. Think about how these insights might apply to your own approach, your own understanding of markets.
Yeah, and always keep that critical thinking cap on. Don't just accept any single one thing as gospel. Use these nuggets to refine your process.
Absolutely. And maybe a final thought to chew on. Given how fast things change and how much psychology still drives markets,
Sure.
what overlooked signposts might be out there today?
What trends are just starting to emerge from the fog now that could shape the next decade or two? That's the ongoing challenge, isn't it? Keep looking, keep questioning.